Welcome to the Mortgage Rate Weekly Market Update for the week of July 16, 2018. Hello, I'm John Thomas with Prime Residential Mortgage, coming to you from the beach to give you your live update here. So mortgage rates ended the week last week about where they started. If you take a look at the bond chart on the screen, you can see mortgage bonds have been trading in a sideways pattern. Last week they made a run just above the 100-day moving average. We were hoping they could rally off of that, but as you see at the beginning of the week, the red candle there, they fell back below the 100-day moving average, traded in a real tight pattern, ended the week right at the top of that pattern, just below the 100-day moving average. So with that in mind, we're going to recommend locking your mortgage rate if you're closing in the next 30 days. If you're closing in 45 days or longer, you could float, but again, cautiously float. If mortgage bonds were to sell off and break below the level of support, we quickly switch to a locking stance. But if you're closing in the next 30 days, go ahead and lock. We haven't been able to break above that 100-day moving average, so the odds you'll get a better rate in the next 30 days, not great. But if you're 45 days or longer, you could take the risk of floating and see if bonds can gain some momentum to break through that ceiling. Now, if we dig into the economic news, we had two reports on inflation last week. The first one, the Consumer Price Index, or the CPI for June 2018. It moved up 0.1% to 2.9% in June for the last 12 months. That's slightly up from 2.8% in May, and that was the largest annual increase of 2.9% since February 2012. So inflation is definitely heating up. That could be bad news for mortgage bonds because inflation is the enemy of bonds. We'll have to keep an eye on that. Then we saw the Producer Price Index, or PPI, for June 2018 come out last week as well. That measures inflation on the wholesale level. That rose 0.3% from 3.1 to 3.4% on a 12-month basis. That is very hot. It's a big jump in producer inflation. We'll have to see if that translates into consumer inflation, which is more impactful on the economic markets. Then we saw weak initial jobless claims come out on Thursday. Claims dropped 18,000 claims to 214,000 claims for the week. This is an extremely low level of claims, showing that the job market remains very tight. Employers are holding on to employees and having trouble finding good employees. We would predict to see wage pressure, inflation tick up if we continue to have low jobless claims. So we'll keep an eye on that as well. And again, if we do see wage inflation, that is bad news for bonds, so that could make interest rates move higher. Now, in the housing news, we saw CoreLogic release their national loan performance insights for April 2018. It showed for loans that are 30 days or more past due decreased from 4.3% to 4.2%, and serious delinquent loans, which is defined as 90 days or more, remain stable at 1.9%. Now on the chart there, you take the 60 to 89 and the 90 plus, 0.6, 0.3, and the 120, which is 1.6, and you add those together, that'll give you your, you take the 0.3 and the 1.6, add it together, that's your 1.9% for seriously delinquent. Now homes in some type of foreclosure remain stable as well, as 0.6%, as you can see there. Now, the question is, with everything going on, should you buy, should you rent? We've got a buy versus rent calculator. So let's do that. Let's say you're buying a $225,000 home in Delaware with an FHA loan, putting down 3.5%. Your mortgage payment on that at 5% would be about $1,552. If you want to rent a similar home, probably cost you $1,500. So you're paying about $52 more per month to own the home versus rent. Now, if we push that out for 9 years and then say you're going to sell the home, the person who owns a home will be ahead by $124,858. That is amazing. Now, the average rental payment after the 9 years would be about $1,928. Well, your mortgage payment will stay about the same. $1,552 is what it's going to be because it's a 30-year fixed with all in. Now, if property tax or homeowners go up, it could go up slightly, but compare that to the rental payment of $1,928. That is crazy. That is why you want to buy a home. You get the price appreciation. Your monthly payments go on to invest in something you own. Even with the cost to buy the house, if you notice there, it still is going to average out. You're going to make way more money than renting. So that should answer the question, should you buy or should you rent? Now, in the local news, we've got next free first-time homebuyer seminar is this Wednesday from 6 p.m. to 8 p.m. in Wilmington, Delaware, at the Independent Small eXp Realty office. And then the next one in Newark, Delaware is Saturday, July 28th, and that is from 10 a.m. to noon at the Christiana Hilton Hotel. You can register for either one of those events by giving us a call in the office at 302-703-0727 or online, www.delawarehomebuyerSeminar.com. CoreLogic.com. Look forward to seeing you guys next week.